Thank you, Evan. Hello, everyone. In a recent CNBC Future of Advice presentation in Miami Beach, tech forward and award-winning Canadian financial planner Jason Pereira reminds the audience, and I quote, "If you're a financial planner with a value proposition of picking stocks or mutual funds for a client, you're in for a tough decade ahead." In fact, fund picking was never really the value proposition for financial advisors in any event. Most clients just want to know if they're going to be okay and if the pot of money they're growing will be enough to solve real human problems, like not being a burden on their family or friends in retirement, or being able to enjoy experiences like travel with loved ones. No one walks into your offices as a financial advisor and asks, will you beat the market or all-share index by 1%? And this is no different for wealthy clients. Jean Brunel, who is a family office advisor in the US, spending much of his career with JP Morgan, gives the story of advising a New York-listed company CEO. His approach centers on taking the necessary time to help his wealthy clients connect with their goals. Brunel paints a picture of this very powerful CEO figure being reduced to tears when asked the question, 5 years from now, what does failure look like to you? The client responds, if I ruin my children, or grandchildren rather, by giving them too much money too easily. How can we advise clients without a deeper understanding of what failure means to these people or in this client's life? Again, as we see in this example, many of these goals are not linked to beating the market or expressed in portfolio returns. As Brunel puts it, he doesn't talk risk and return with clients, he talks dreams and nightmares. Deeper investigation into Brunel's process reveals that he doesn't shy away from the technicalities of financial markets either, being a CFA charterholder himself, but only gets to this once he has a very clear picture of what is important to the human being he's dealing with. So what does the future hold? Advisors are already using AI tools like Podcastle to sample and clone their voices and generate podcasts for their clients in minutes to supplement financial education and market commentary, for example. Use generative AI like ChatGPT with Podcastle and you're generating content in the fly in a fraction of the time it used to take. If you want to go a step further, you can even create an avatar of yourself to deliver that message in person. The new Advisor's Toolkit, however, is simultaneously filling up with more EQ toolsets. As AI can manage tax efficiencies in a client's portfolio and discretionary fund managers, for example, chart the optimal mix of investments to get clients to their goals. Advisors now have the time and space to explore what really matters to their clients, and of course that is their dreams and nightmares. Financial service providers have a big role to play here too. By supporting financial advisors with in-the-moment insights and feedback about the effect of their behavior, the financial advisor can provide more just-in-time financial education. When clients are about to perform an action that could cost them in the long term or incur the behavior tax, or a lower investment return rooted in cognitive or emotional bias. Added to this would be systematically assessing the impact of the client's attitudes and personality on their dreams and nightmares without creating noise or random variations in advice that are not coming from change in client circumstances. In fact, personality science could be reshaping the scientific method itself. In a paper published in the Harvard Business Review in 2018, the authors argue that using machine learning to identify so-called high-risk customers, or those at risk of leaving the business, may be ineffective because firms are offering the wrong incentives to change that behavior. In other words, identifying a customer as high risk for a certain behavior, and switching could be one of these, could be ineffective if we design an intervention assuming everyone will respond to that intervention in the same way. With personality science, we can certainly understand more about the people behind the behavior. The implications of this paper are quite significant in that the scientific method of the future could have multiple interventions designed to be more effective to the target groups they are aimed at. So we could try and change switching behavior using different interventions, depending on whether someone is anxious or displays an inclination to focus on the present over the future, for example. This makes so much sense and sharpens our judgment significantly in respect of what works and what doesn't. If we think about it, previous interventions that were deemed unsuccessful may just have been unsuccessful on average, without more detailed information of the population. So interesting times ahead, indeed. But the question is, how will psychology slot into financial advice? According to the CFP board in the United States, financial decisions are rarely made based on logic alone. According to a Capital One survey, more than 75% of Americans reported feeling anxious about their financial situation in January of 2020. Consumers' financial stress has only gotten worse due to subsequent record high levels of inflation, with nearly 90% of Americans citing this as a top financial planning concern. As is clear globally, people tend to make mistakes when they're under stress, and particularly when they feel in danger of losing money. In South Africa, since the COVID period, the behaviour tax has remained alarmingly high. Approximately 3.5% of clients' annual returns on average are being sacrificed from trying to time markets. These are the highest levels ever experienced since momentum investments have started to track this metric. In line with psychology making its way into the CFP syllabus, advisors need the tools to systematically diagnose and guide clients with different attitudes to money, personality traits, and risk behavior history to try and avoid this behavior tax, despite these inherent characteristics. AI most definitely has a role to play here too. As it stands, the best way to diagnose someone's personality, for example, is through a questionnaire. In other words, to ask them about their attitudes towards money, or whether they think about the future consequences of their actions, such as saving or indeed not saving. This year, Momentum Investments, in partnership with our channels, will test what we call a money fingerprint that helps advisors diagnose and predict their clients' risk behavior, day-to-day money management behavior, and links to their personality. I've personally witnessed now early trials in coaching programs that couples with very different money fingerprints are quite likely to experience conflict. For example, an introverted and structured organizer very focused on the future who worries about money will likely butt heads with an extroverted, impulsive spender who doesn't worry about money at all. What makes this trickier is where there is an imbalance in earnings. The dominant couple behavior will likely mirror the breadwinner's preferences that can isolate the remaining partner, who may then act out in manners that are completely unrelated to money. For example, withholding affection, time, or being present in the relationship. The reality is that more than 1 in 5 divorces are because of these money conflicts, as cited by the US CFP board. In the future, we could very well see AI being successful in predicting a client's personality and money attitudes from their social media footprint or even smartphone sensors. Studies are already surfacing predicting the level of extroversion from smartphone location data that reveals where people are on a Friday night, for example. At home watching Netflix, which may be linked to introversion, or out and about linked to extroversion. Music preferences, the diversity of your iTunes playlist, for example, may predict your level of broad-mindedness or curiosity, which can be supported by Facebook likes, for example. As the open banking trend moves to South Africa and transactional spending data becomes more and more available, this could also support prediction algorithms even more. Regardless of the efficacy of AI in this arena, personality diagnosis and the application thereof in financial planning is likely to increase. Later this year, in partnership with a number of Momentum business units, we'll be exploring using machine learning to predict longevity in retirement to help our advisors give behaviorally informed advice. Should advisors recommend a life annuity or a living annuity, or both? This is not an easy decision to make, and machine learning can most definitely make the choice far simpler for advisors when linked to health data, like medical claims, for example, or behavioral data, like how active the person is. Another example of using computational efficiency to allow advisors to focus on dreams and nightmares. But how have we been using machine learning to date? Unsupervised machine learning, or clustering, helps us to understand the structure of behavior patterns over time, and indeed if these were changing or not. While everyone tends to have stable attitudes towards risk over the long term, we like it or we don't, the reality is that how risk feels to each of us in any given moment is likely to be far more volatile. This has been shown to be the case in a number of experiments where investors who experience consistent negative outcomes tend to feel more risk or heightened risk levels, while those that experience consistent positive outcomes tend to feel reduced levels of risk. Both groups usually adjust their investment behavior accordingly. These patterns or clusters of behavior came through rather strongly since the onset of the pandemic in 2020. When looking at each and every switch decision made by investors on the Momentum Wealth Unitrust platform since 2020, 4 clear behavior patterns become evident, each with varying consequences for the investor. The most value is consistently destroyed by the market timer cluster. These investors are the most active, executing the greatest number of investment decisions. In other words, they switch the most. They chase higher past investment performance and also lower past investment performance. In the latter case, this is usually reflected by moving to the cash side of the risk spectrum. The second highest behavior tax is incurred consistently by the assertive investor. In 2022, they incurred the greatest behavior tax of 4.5% of investment returns when no other archetype incurred a behavior tax for that year. As the name implies, the assertive investor chases past investment performance consistently. This behavior is usually associated with up-risking of the portfolio. Third, we have the loss-averse anxious investor. This archetype doesn't mind taking investment risk, but is very sensitive to paper losses. At the first sign of these, they tend to shift their investments towards historically lower performing investments, like cash. This is usually associated, once again, with de-risking the portfolio as well. Finally, we have the risk-averse avoider archetype. These investors tend to invest the most conservatively and then get stuck there. They switch the least and move money in between the same risk category investments when they do switch. They are likely the yield chasers seeking more security. We also need to remember that these investors may pay another form of behavior tax, being an opportunity cost of investing too conservatively, perhaps over a lengthy period of time. While unsupervised machine learning algorithms are a great way to show the structure of behavior or preferences over a period of time, supervised machine learning like artificial neural networks or random forests that use a decision tree kind of architecture are a great way to help us predict behavior. In a recent paper published by Momentum Investments, we showed around 9 different features that are strong predictors of investor switching behavior. These 9 features relate strongly to risk behavior literature and clearly show that how we behave when we make investment decisions is a function of how risk feels to us or how we perceive risk in the short term, as well as our belief system about the way the world of investing works. A feature of using supervised machine learning, like the random forest for example, is that we can extract exactly how much of an impact each of these factors have when the investor considers making a switch decision. The top line of factors related to the investor's age, the number of funds in the portfolio, and the portfolio value. When using a technique called Sharpe values, it becomes clear that portfolio value doesn't have much impact until the portfolio value exceeds 300,000 Rand. Then it has a big impact on predicting the switch. Age also doesn't have a uniform impact. Investors become more likely to switch over the age of 50 and then become less likely to switch over the age of 80. When it comes to the number of funds in the portfolio, as this exceeds 10, the likelihood of switching increases sharply once more. All 3 of these factors support the fact that approximately 75% of the behavior tax occurs in living annuities or people who are in retirement already. This also confirms that people in retirement are particularly sensitive to changing portfolio values. Next, we see the investor's belief system is also important. Using Sharpe values again, we saw that if the investor has only switched once before, this has little predictive power. But if they've switched 2 times or more, the likelihood increases sharply that they'll switch again, particularly as the size of the switch transaction increases over 100,000 Rand. This is also linked again to the portfolio value. Finally, risk perception also relates to the investor's 6-month and 12-month investment performance or outcomes. Here it's a bit more difficult to tell exactly where the sweet spot is, but given the importance of the 6-month and 12-month performance, and given that these intervals are usually linked to review periods with advisors, it seems that financial advisors are definitely linked to the behavior. And this is where these types of information regularly surface. When combining the 2 techniques, the results are both interesting and encouraging. When tagging each investor with the cluster labels we mentioned earlier, and then apply these to the predictive model to analyze any differences in switch predictions, the random forest algorithm places the market timer archetype as the one that consistently has the higher prediction to switch. Approximately twice as likely when compared to the anxious archetypes and 3 to 4 times as likely as the assertive and avoider archetypes respectively. This was over a relatively short period study. Also note the 2 dotted line boxes for the anxious investor where the switch prediction rises during periods of high market volatility in these 2 periods in 2021. These investors are anxious. The market timer prediction similarly spikes in the white box with a sharp market recovery early in 2022. The predictive algorithm is confirming what we know about the investor groupings. In other words, that investors are not homogeneous in their predictive behavior. Some groups are more or less likely to engage in the behavior at different periods of time. The group with a consistently greater switch prediction value is called the market timer for exactly this reason. Finally, we can evaluate overall effectiveness of the predictive model by examining how much lift the model gives. In other words, how much more likely it is to give a correct switch prediction when compared to a random coin toss model. Lift curves demonstrate how well the model ranks investors by their likelihood to switch for different percentile model scores. On your screens are the results for the different data segments used in building the model. The 20 million observations from over 90,000 clients are split into what is called training data for the algorithm to learn relationships between the features we discussed and the behavior, which of course is switching. We then expose the model to new data it hasn't seen before to explore how effective it is in predicting the behavior. Here we see the data the model is trained on is almost 10 times better than a random model at predicting switch behavior. This is the red line. To the two new time periods of data, however, the model is approximately 7 and 8 times as effective as a random model, respectively. We would expect these slightly lower results for the new data, as the model will always misidentify noise as valid signal in the training process. These results show the model is very effective, however, in prediction and provides an excellent application of machine learning to the value proposition of the behaviorally informed advisor. Once the AI has generated behavioral insights and predictions, the next step is to conduct experiments to see which approach would be best in shifting the behavior to the benefit of the investor. Earlier we talked about where psychology and personality science fits. We need to know more than just a prediction from an algorithm. Just because we can predict something doesn't mean we can necessarily change it. We also need to understand how likely that person is to respond to our intervention. This is where personality science can play such an important role. If we know that the switcher has a particular personality trait, for example, neuroticism or high levels of anxiety, we could position the intervention as reinforcing the safety of staying invested in the long term. Literature has also supported the fact that a safety message appeals to people with this trait. This is the key message here. The more we know about the person we're aiming the intervention at, the more likely we can change that behavior of the people the algorithm is giving a strong prediction for. More literature and evidence is also emerging of intervention failures, backfiring, and even unintended consequences. We can't simply assume that warning investors of something will have a positive effect. Machine learning is great at learning patterns in large datasets, but it also learns noise. We can't guarantee that we only contact investors that are going to incur a behavior tax when making a switch decision, or that by contacting investors about switching, we actually don't inadvertently cause that switch. This is where the field of behavioral science has a larger role to play in the scientific process and ensures that overall we are making a positive change to investment behavior. While there are many suggested approaches and frameworks in behavioral science, we use the basic framework used by the OECD and taught by the iNudgeU Institute in Denmark. This basically summarizes behavioral problems into one or more of 4 following root causes. Firstly, there are attention problems. Are investors shifting money around between unit trusts because they have a focus problem? Said differently, is their attention in the wrong place or being drawn to the wrong place at the wrong time? Where do investors get performance information from? Is it from an MDD or fund fact sheet, or perhaps from a report the advisor is giving to the client? Is there too much clutter around the information that matters to clients? Said differently, can clients answer the simple question, am I okay, from all the information overload that they receive? If not, this could be part of the problem. Secondly, there are belief formation problems. We've already seen that the win, stay, lose, move belief system is very much alive and well with investors. How do we change this? Certainly a big influence here is the financial advisor. How can we change the financial advisor's belief system? A recognized technique uses support judgment, for example. We are social creatures and tend to behave as others behave, and also look for confidence in behavior of other people or people that we respect. How do we change the win, stay, lose, switch belief system? How do we reinforce the right behavior? Thirdly, there are choice problems. Can we perhaps frame switching as something negative, perhaps like a switch itch? Can we also trigger more of a sense of community, perhaps by alerting investors to those who are not switching? Finally, there are determination problems. These are in essence willpower problems. How do we get investors to commit, even socially, to staying invested? We sometimes do different things when people are watching, particularly those we respect. Can we provide real-time insights and feedback into the cost of switching to other investors, such as the behavior tax? Will this have an impact in reducing the behavior, and by how much? These are important questions, some of which we don't as yet have answers for. But behavioral science is not about having all the answers. It's about being inquisitive, failing often and fast, and moving on to the next question. The challenge for financial services providers is to create the environment and technology to conduct these multiple experiments and help us in acquiring a new mindset that return on failure is also valuable. It's not just about return on investment. There is never one correct recipe or intervention, and decision context is highly variable. This is where the science in behavioral science comes in. Experimenting and figure out what works and what doesn't. This area is going to be a big focus area for us as a business in the near future. The behaviourally informed financial advisor sets the scene for the future of financial advice, where speaking about better returns and picking better funds is replaced by better connection and better decision making. You've all probably seen the internet meme where author and video game enthusiast Joanna Maciuska says, "I want AI to do my laundry and dishes so that I can do art and writing, not for AI to do art and writing so that I can do more laundry and dishes." While we've been talking about AI as an enabler of better decision making, this is likely to empower financial advisors as the ultimate interpreter of the client's unique decision context. So the advisor with better knowledge of their clients decides on whether to pass on the nudge or not. Again, the advisor remains an important cog supported by AI and not replaced by AI. This also means that true connection replaces tone-deaf financial education. In a well-cited example, a financial advisor is sitting down with a prospective client who has just received a tax rebate. The client informs the advisor of her intention to buy a big flat-screen TV with the proceeds, and naturally the advisor continues to object to this decision, citing wonders of compound interest over time and the client's dire retirement forecast. As it turns out, though, in this specific case, however, the client is living in a rough neighborhood and is buying the TV so her two kids stay at home at night where, of course, it's more safe. This is an example of where the right answer is wrong. We should never assume to know better than people we are advising. After all, we are all experts in our own lives. Financial psychologists Brad and Ted Klontz give evidence in their book titled Money Mammoth that behaviorally informed financial advice uses principles in financial psychology is more than 3 times as effective as using financial education alone in changing that behavior. Bombarding people with information, even though correct, can be ineffective. A financial advisor who spends more time listening becomes very tuned into that client's unique circumstance and has more valuable insights to offer, which behavioral interventions are needed in order to change that behavior. When these contextual insights are combined with machine learning insights and personality science, the advisor uses technology and hyper-personalized client engagement that is applicable to that client's unique circumstances. In other words, the advisor remains the ultimate decision maker in guiding which content is delivered to which client and when. This could be a personalized podcast on the importance of staying invested, but providing actual feedback on the effects of past investment decisions and the impact this has had on that specific client's wealth. Or perhaps how inflation works, but in the context of that client's cash balance over time, so the effect of their risk-avoiding behavior on their portfolio over that period of time. These insights, when paired with techniques in financial psychology to track and measure behavioral change, is where financial advice is headed. Thank you so much for your time.